Hello ladies and gentlemen, boys and girls, this is Satvik back with another video. In this video, we'll be talking about futures. Futures is part of the derivatives world. The derivatives consist of mainly futures and options. So what are derivatives? Derivatives is a security whose value is based on another financial entity, referred to as an underlying asset. The underlying asset can be stocks, bonds, currencies, etc. Say for example Nifty futures. We all know what is Nifty, right? Nifty is basically an index consisting of 24 sectors representing how the major companies of the particular sectors are doing. So the value of Nifty futures is based on the value of Nifty. If Nifty goes up, Nifty futures will go up, and if Nifty goes down, Nifty futures will go down. Now the question comes, why does it even exist when we can very well trade the index directly? The answer to that question is no, you can't trade the index directly. So what is a futures contract? A futures contract is a legal agreement that binds the buyer and seller to trade specific assets at a predetermined price and date in the future. I'll give you a simple example so you'll be able to understand this a bit better. Let's assume that you own an airline company and you think that the price of jet fuel is going to shoot up next month. So to protect yourself from the upcoming bullishness that you're expecting, you decide to get into a futures contract. Whereas your fuel distributor exactly has the opposite view of the market. That is, he thinks that the price of jet fuel is going to go down. So to protect himself from the bearishness that he is expecting, he too decides to get into a futures contract. So you both agree upon the contract, that is, he'll be selling and you will be buying 100,000 liters of fuel at 100 rupees per liter. No matter where the price goes, he is obliged to sell and you are obliged to buy at a particular price you both agreed upon at the beginning of the contract. A futures contract will typically specify all the different parameters of the trade, like how the trade will be settled, either with a physical delivery of the given quantity of the goods or with a cash settlement which the speculators use. I'll come to the speculators part later. But in stock market, the future contracts that are readily available to buy and sell over the exchanges are standardized. Coming back to the example, there are three scenarios that can take place in this deal. Let's analyze each one of them. If the price goes up to 102 per liter, you will be making a profit of 1 lakh into 2, and the seller has to settle it with cash or do the physical delivery depending upon the agreement. If the price goes down to 98 per liter, you will be making a loss of 2 lakhs. Again, depending upon the agreement, you will have to take the physical delivery or settle it with cash. If the price remains the same, both the parties neither make a profit nor a loss. But not everyone in the futures market wants to exchange a product in the future. These people are known as the future investors or speculators who seek to make money off of the price changes in the contract itself. If the price of the jet fuel increases, the future contract itself becomes more valuable and the owner of that contract could sell it for more in the futures market. These type of traders can buy and sell futures contract with no intention of taking delivery of the underlying commodity. The capital required to buy one lot of Nifty futures is 1.1 lakh rupees. The minimum you can buy is one lot. So one lot of Nifty futures is 50 quantity of Nifty. The current price of Nifty is at 18,600. So 18,600 into 50 is 9.3 lakh. That is the amount of capital you need if you want to buy it in cash market. But with futures you can buy it at just 1.1 lakh rupees. By the way guys, you can't buy indices in cash market. If you come to stocks, say for example if you want to buy Infosys futures. Infosys is priced at around 1,315. One lot of Infi is 400 quantity. So 400 into 1315 is 5.26 lakhs. That is the amount of money you need if you want to buy it in cash market. Whereas with futures you can buy it at just 94,000 rupees. So with futures you'll be paying only the margin guys. Now you may ask, what is margin? I'll come to the margin part later. Futures are very risky compared to cash market as you can lose more than you invested. Sounds crazy, right? I'll give you an example. Let's assume that you bought one lot of Nifty futures at the current price, that is 18,600. As we all know, to buy one lot of Nifty futures, we need a capital of around 1.1 lakh rupees. So if the market goes down to 16,600, that is 2,000 points below the level at which you bought, you will be losing your entire capital. As one lot of Nifty is 50 quantity and 2,000 into 50 will be almost equal to your capital. The probability of this situation is extremely low, but definitely a possibility guys. Trading in futures and options as a beginner is indeed a really bad idea. If the market starts going against you, the broker will give you a margin call or the risk management system could cut your position. At the time of taking the position, you are required to pay the initial margin, that is the span plus exposure margin. The span margin is based on a statistical concept called VAR, that is the value at risk. The initial margin, that is the span plus exposure margin, should be large enough to cover the losses in most cases, but there are black swan days, that is a different issue. The initial margin requirements are based on a 99% value at risk, but in case of future contracts where it may not be possible to collect mark to market settlements, the margin is calculated over a 2-day time horizon applying the appropriate statistical formula. The methodology of computation of value at risk is as per the recommendations of SEBI and it varies from time to time. The initial margin varies from 10 to 15% of the notional value of the contract depending upon the risk and volatility of the stock. Say for example Nifty futures. The notional value of Nifty futures is 9.3 lakh and the initial margin is 1.1 lakh. So it is around 12% of the notional value of the contract. As I said, it varies from 10 to 15% depending upon the risk and volatility of the stock. The span plus exposure margin changes 5 times during a trading day depending upon the intraday volatility. So if you are already holding a position from before and the initial margin goes up, your account could potentially be short of the minimum required span plus exposure margin, leading to peak margin penalty. The last final file is published at 5:30 p.m. capturing the stock's movement during close market hours, and the margins are updated accordingly in the EOD file, the end of day file. There are mainly 6 differences between futures and cash market. First one is leverage. As we all know, we get more leverage in futures. That is, we can trade more quantity with less capital as compared to cash market. Second one is quantity. In futures, the minimum quantity you can trade is 1 lot, whereas in cash market, the minimum quantity you can trade is 1. Third one is index trading. In futures, you can do index trading, whereas in cash market, you can't trade the index. Fourth one is dividend. You will not be receiving any dividend in futures, whereas in cash market, you will be receiving dividend as you are the shareholder of the company. What are dividends? Again is a topic for another video. Fifth one is time restriction. 3 futures are available for trading at a time. So this is June. June, July and August futures are available for trading. Futures expire on last Thursday of every month. You can exit before expiry. Whereas in cash market there is no time restriction. Sixth one is shorting. In futures you can hold a short trade overnight, whereas in cash market you can only do a short trade in intraday. Now let's look at why futures trade at a higher price compared to spot. The differences in prices of the future is due to the differences in rates of interest, dividends and the period to the expiry of the futures contract. Difference in the cost of the future currently and its price in the future is known as spot future parity. The mathematical representation of how the futures price changes according to the changing variables of the market can be represented using this formula, where X represents the number of days to expiry and RF is the risk-free rate. The risk-free rate is what you are able to earn throughout the year in perfect market conditions, and D represents the dividend. This futures formula gives you what is known as the fair value. The difference between the fair value and the market price is due to the transaction charges, taxes, etc. As the future gets closer to expiry, prices naturally converge. You don't have to wait till expiry to sell. You can sell at any time and vice versa. There are mainly 2 types of traders in futures market, hedgers and speculators. So what is hedging? Hedging is basically a risk management strategy, guys. I'll give you an example. Let's assume that you have invested in Tata Motors and you have a bullish view on the market for the long term, but you have a bearish view on the market for the short term. That is, you think that the market is going to experience a correction before continuing its rally. So what you can do here is you can take a future short position to offset the losses in cash market of your position. So this is a hedging position, guys. Now coming to the speculators part, speculators are the highly sophisticated investors or traders who usually take short-term trades. They employ strategies to make a profit. They are very important in the market as they bring a lot of liquidity. They take high risk, high reward trades. Some are mere speculators, meaning they take trades based on gut feeling. The idea here is to be on the right side of the market to make a profit, but not in the case of options. Again is a topic for another video. Thank you so much for watching.